After a multi-month decline in interest rates, we are seeing positive momentum in housing start to emerge in the new year. Let's look at some of the numbers from this past week and highlight some of the events to watch in this week's Mortgage Market Update. Is it spring in January? Well, not quite, but we've seen an uptick in inventory and mortgage applications over the last couple of weeks. This should be no surprise as interest rates move sharply lower between the months of November and December. Much like we saw last year, with any dips in rates, housing activity picks up. If rates remain near current levels or slightly improved and the labor market remains tight, we should see far more purchase activity in 2024. As Lawrence Yun, chief economist of the National Association of Realtors, stated, life goes on. There is a lot of pent-up demand and housing could have a surprise year in activity. As for the new floor, the 10-year note has been hovering around the 4% mark for the past few weeks, a further sign of some stability in the bond market. There is still much debate and uncertainty surrounding how many Fed rate cuts we will see this year. Currently, they are forecasting 3 cuts in 2024. The Fed Fund futures, which price in the probability of rate cuts, are suggesting the Fed will cut rates 6 or 7 times. Someone will eventually be proven right. At the moment, I am forecasting 3 to 4 rate cuts by the Fed this year, with the first to come as early as May. A not-so-rosy jobs report. The jobs report recently reported for December showed 216,000 jobs were created in the economy. The media and others were celebrating the strong headline number. However, interest rates, which hate good news, didn't rise in the days since the release. Now, why is that? A closer look under the hood of the report showed that the economy lost 1.5 million jobs in December, as shown in the household survey within the release. And we hit a record high of 8.5 million people working multiple jobs. So overall, the job report was not so good when you look at some of the internals. If future labor market readings show similar weakness, it could prompt the Fed to cut rates sooner than the middle of the year. Consumer inflation is mixed. The December Consumer Price Index was reported on Thursday, and overall it was in line to slightly higher. Overall inflation rose 0.3% for the month, which was 1/10 hotter than estimates. Year-over-year inflation increased from 3.1% to 3.4%, but a big part of the increase was a very low comparison to last year, which will improve going forward. The core rate, which strips out food and energy prices, increased by 0.3%, which was in line with estimates. Year-over-year core CPI declined from 4% to 3.9%, which was 1/10 hotter than estimates, but significant in the fact that it has a 3 handle. Shelter cost remains the largest contributor to overall inflation, making up nearly 2/3 of the core CPI and rose 0.5%, yet has been cooling. Shelter is now up 6.2% year over year, down from 6.5%. On Friday, the Producer Price Index, or PPI report, which measures wholesale or producer inflation, fell 0.1% in December, which was 0.2 lower than the 0.1% rise expected. Year-over-year, producer inflation rose from an anemic 0.8% to 1%, and while it rose, it was expected to rise 1.3% because of the very weak comparisons from last year. Still, 1% year-over-year inflation is very low. The core rate, which strips out food and energy prices, came in at 0%, which was lower than the 0.2% anticipated. Year-over-year core inflation fell from 2% to 1.8%, while the market was expecting 1.9%. Overall, this was a cooler inflation report on both the headline and core readings. Much of the PPI components also go into the Fed's favorite personal consumption expenditures report and should lead to lower producer inflation, which often leads to lower consumer inflation, and those savings are passed to the consumer. Bottom line, the trend in inflation remains to the lower, the economy is slowing, and the labor market is loosening gradually. All of this should help lower rates while also avoiding a deep recession or a recession at all, and this would be wonderful news for housing. Now, looking ahead, this week is a bit quieter in economic news, yet we will get several readings on the housing market. Last year, every dip in rates was met with an uptick in housing activity. We shall see if these readings support NAR's Lawrence Yun's take that housing activity has indeed picked up. We will also get a fair amount of Fed speak, and they will likely try to jawbone down the rate cut expectations that right now seem to be flying high. As always, thanks for hanging with me for this week's Mortgage Market Update. Be sure to like, comment, share. I'm always here to help, and I look forward to funding your future. Have a great week.